It was the kind of morning that made people sick to their stomachs. The kind where you checked your account balance, closed the app, and then opened it again, hoping the numbers had somehow changed. They hadn't. Markets were in freefall. Retirement accounts that families had spent decades building were being cut in half in a matter of weeks. Financial institutions that had stood for over a century were vanishing almost overnight. The news was relentless. Every headline was worse than the last. Experts who were supposed to know what was coming had been completely blindsided. Ordinary people were terrified. And in the middle of all that fear, a nurse named Carol from a mid-sized city in Ohio did something that almost everyone around her thought was reckless. She had been quietly saving for years. Not because she earned a fortune. She didn't. But because she was disciplined, methodical, patient. She had built up a little over $48,000. That money was supposed to become a down payment on a home she'd been planning to buy. Instead, she walked into her bank, moved that entire sum into a broad market index fund, and went back to her regular life. Her colleagues thought she had panicked in the wrong direction. Her sister called her twice in 1 week, begging her to pull it back out. Her own mother stopped asking about it entirely because the conversation always ended in an argument. Carol stayed quiet. She stayed invested. And she waited. That $48,000 is today worth just over $500,000. She didn't pick individual stocks. She didn't get a tip from anyone. She didn't have access to tools or information that you don't have right now. Or she simply recognized that a specific kind of moment had arrived. A moment that history shows comes around perhaps once or twice in a generation. A moment when conditions align in a way that moves enormous amounts of wealth from one group of people to another. And most of the people who benefit aren't the ones you'd expect. They're not hedge fund managers or technology executives. They're nurses and teachers and warehouse supervisors and small business owners who simply happened to be paying attention and willing to act. Most people watching this right now have no idea that we are living through one of those moments again. Not a market crash this time. Something different, something that operates more quietly, but at a scale that is genuinely difficult to comprehend. A convergence of forces that experts are only now beginning to fully document. Forces that independent research suggests will move more wealth into the hands of regular middle-class families than any single event in the history of this country. And the vast majority of people have no idea it is already underway. The recovery that followed that fearful period Carol invested through did not just stabilize. It became the longest sustained market expansion in American history. The index that had been in freefall climbed back slowly at first, then steadily, then remarkably. Over the following decade and a half, it rose by more than 900%. The people who captured most of that gain were not professional traders. According to wealth research published in recent years, the households that benefited most were ordinary working families who simply kept contributing to their retirement accounts during the years when headlines were screaming that everything was about to collapse. The data that came out of that period is striking. In 2010, the United States had roughly 8.5 million millionaire households. By the end of 2024, that number had grown to nearly 24 million. The country created more than 15 million new millionaire households in under 15 years. 15 million. That is roughly equivalent to the entire population of the greater New York metropolitan area, crossing the $1 million threshold within a single generation. And the majority of those people did not get there by selling a company or receiving a massive inheritance or making a lucky bet on a single stock. They got there through something far less dramatic. They stayed invested in broadly diversified markets through years of uncertainty and volatility, and compounding did the rest. According to research from one of the world's largest financial institutions released in 2025, the United States alone added close to 380,000 new millionaires in a single year. That is more than 1,000 new millionaires every single day. Most of them were not dramatic success stories. They were quiet accumulators, people who made consistent decisions over long periods of time and allowed the mathematics of compounding to do what it does when you give it enough runway. This group now numbers over 50 million people globally. They collectively controlled trillions in wealth. And the path they took is not a secret. It is documented. It is repeatable. And here is the part that most people are not yet aware of. It is about to get significantly easier for the next wave of people to follow it. What makes this current moment so different from anything that has come before is a single number. That number is $124 trillion. That is not a projection from an optimistic analyst trying to sell you something. That is the figure that comes from independent wealth research organizations tracking what is already in motion. Over the next 2 decades, $124 trillion in assets is going to change hands. It is already changing hands right now as you watch this. To put that number in perspective, it exceeds the total annual economic output of every single country on Earth added together. It is more than 5 times the current national debt of the United States. It represents 8 decades of accumulated American economic expansion about to move through the generations in a compressed window of time. The mechanics behind this number are straightforward. There is a generation that currently controls an extraordinary concentration of national wealth. People who were born in the years following World War II, who formed households during a period of explosive economic expansion, who bought homes before prices made that nearly impossible for young people, who participated in pension systems and stock markets during the greatest sustained bull run in recorded history. That generation now controls roughly half of all wealth in the United States, and the youngest members of that generation are now in their early 60s. The oldest are approaching 80. Over the next 20 years, that wealth is going to move. It will move to their children. It will move to their grandchildren. It will move to charitable organizations. And when $124 trillion moves, it does not simply transfer quietly from one account to another. It ripples through the entire economy in ways that create opportunities for people who understand what is happening. The last time anything even remotely comparable to this occurred was in the years following World War II, when a generation of returning soldiers used newly available government programs to buy homes, start businesses, and build what became the American middle class. That wealth creation event was transformative. It produced the very generation that is now preparing to pass that accumulated wealth forward. What is coming is the echo of that moment, but at a scale that makes the original look modest by comparison. The parallels between that post-war moment and the current period reveal something important about how wealth creation events actually work. In both cases, 3 conditions aligned simultaneously. First, a massive pool of capital was preparing to move into the broader economy. After the war, it came through government programs and veterans returning with intent to build. Today, it comes from the largest generational wealth transfer in recorded history. Second, a significant shift in who controls investment decisions was underway. After the war, it was a new generation of middle-class families making financial decisions for the first time. Now, today, it is millennials and Generation Z beginning to inherit and direct trillions in capital, with investment preferences that differ significantly from the generation before them. Research from major financial institutions shows that younger investors are far more likely to direct capital toward technology infrastructure, clean energy, healthcare innovation, and emerging asset categories than their parents were. This is not a minor shift in taste. It is a fundamental redirection of trillions of dollars toward different sectors of the economy. Third, and perhaps most importantly, in both cases, the majority of people were either unaware of what was happening or too distracted by short-term concerns to act on it. This is the detail that separates the people who look back on these moments as turning points from those who look back on them with regret. The information about what is unfolding right now is publicly available. The research reports documenting this transfer are not behind paywalls accessible only to the wealthy. They are available to anyone willing to look. The challenge has never been access to information. It has been the willingness to act on it while the moment is still in motion. Understanding where this capital will actually flow is what separates a general awareness of the opportunity from being genuinely positioned to benefit from it. The first thing to understand is that inheritance alone will not create most of the new millionaires this transfer produces. This seems counterintuitive given the headline numbers, but the underlying data makes it clear. The wealth being transferred is highly concentrated. The majority of it sits within a relatively small number of high net worth households. Most middle-class families will receive inheritances that are meaningful but not life-changing on their own. What they will receive, however, is exposure to an economy that is being supercharged by over $100 trillion in moving capital. When that much money flows into investment markets, asset prices rise and everyone already invested benefits. When it flows into real estate transactions, property values appreciate and existing homeowners gain equity. When it funds new businesses and ventures, job creation accelerates and wages rise. The opportunity is not simply in the inheritance itself. It is in the cascading economic effects of that much capital in motion all at once. The second dynamic worth understanding is the geographic dimension of this transfer. Wealth is not going to land evenly across the country. Research consistently shows that younger generations are concentrating in specific metropolitan areas, driven by employment opportunities, quality of life, and industry clusters. Markets that are already attracting younger, higher-earning workers are likely to see intensified real estate demand as newly wealthy millennials and Gen Z individuals enter the housing market with more capital than previous generations had at the same life stage. Meanwhile, markets that have seen population decline may see an increase in inventory as properties pass through estates. The divergence in outcomes between these two types of markets over the next 2 decades is likely to be significant. Where you choose to own real estate over this period may matter as much as whether you own it at all. The third dynamic is about the industries that grow when trillions of dollars change hands. Wealth in motion creates demand for services. Financial planning, estate administration, tax advisory, real estate brokerage, legal services, and wealth management are all positioned to expand substantially as the transfer accelerates. People who develop skills and expertise in these areas over the coming years are not just positioning for career growth. They are aligning themselves with one of the most powerful economic tailwinds of this generation. The fourth dynamic involves a transfer stage that most people never hear discussed. Before the wealth moves to the next generation, it first passes, in many cases, to surviving spouses. Research estimates that tens of trillions of dollars will pass to widowed partners before eventually moving to children and grandchildren. A disproportionate share of that spousal transfer will go to women, who on average outlive their male partners. This creates an enormous and growing market for financial services and support designed specifically for women managing wealth, often for the first time later in life. Advisors and professionals who position themselves to serve this demographic authentically and competently will find consistent and growing business throughout the transfer period. Here is the part of the story that people almost always miss when they look back on wealth creation events. Oh, they never feel like golden ages while you are living through them. The years following that fearful period Carol invested through were not smooth or comfortable. They were filled with crises that seemed, at the time, like they might end the recovery entirely. There was a sovereign debt crisis in Europe that sent markets tumbling. There was political gridlock that brought the government to a standstill. There was a global trade dispute that created genuine uncertainty about international commerce. There was a pandemic that crashed markets faster than almost any event in modern history. At each of those moments, the dominant emotional experience for most investors was fear. And at each of those moments, the correct financial decision in retrospect was to stay invested. Our research into market behavior over this period shows that the cost of exiting at the wrong moment is enormous. Missing even a small number of the best performing days in the market, which tend to cluster during the most volatile and fearful periods, reduces long-term returns dramatically. The impulse to protect yourself by moving to safety is understandable. It is also, historically, one of the most expensive financial decisions ordinary people make. Carol felt that impulse every time a new crisis dominated the news. She told people later that there were at least 4 or 5 moments when she came close to moving her money out. What stopped her was not certainty that things would recover. She had no such certainty. What stopped her was a simple decision she had made at the beginning to give her investment a decade before making any judgment about whether it had worked. That decision alone was worth hundreds of thousands of dollars. The great wealth transfer will create its own versions of those fearful moments. Recessions will occur. Markets will correct. Headlines will declare that the old rules no longer apply. And the people who stay positioned through those moments will be the ones who look back on this period as the time everything changed for them. Let's make this concrete with actual numbers, because abstract concepts about wealth transfer are not what changes people's financial trajectories. Specific numbers do. Consider someone who is 35 years old today. They begin investing $500 a month into a diversified low-cost index fund, and they maintain that discipline for the next 25 years, roughly the span of the Great Wealth Transfer. At a 7% average annual return, a figure considered conservative by most long-term market analysts, that person accumulates approximately $475,000 from $150,000 in total contributions. At a 10% average annual return, which is closer to the long-run historical average of broad market indices, that same person accumulates approximately $660,000. Now factor in the potential tailwind from the wealth transfer itself. Now, research suggests that sustained capital inflows of the kind expected during this transfer period may support returns that run slightly above historical averages due to increased investment activity across the economy. Even a single percentage point improvement in average annual returns meaningfully changes the long-term outcome. At a $1,000 per month contribution rate, which becomes achievable for many people as their careers progress, And the path to $1 million through consistent index investing becomes straightforward mathematics rather than wishful thinking. These are not exotic strategies. They do not require sophisticated financial knowledge or access to exclusive investment vehicles. They require three things: starting, continuing, and refusing to stop when it feels uncomfortable. Now, translating all of this into an actual framework for action requires cutting through the noise and focusing on what the research consistently shows actually moves the needle for middle-class households. The most impactful single step for most people is maximizing contributions to tax-advantaged retirement accounts. Every dollar that compounds inside a retirement account does so without being reduced by annual taxes on gains. Over decades, that difference is enormous. Current contribution limits allow for tens of thousands of dollars annually across available account types. People who are not maximizing these accounts are leaving a compounding advantage on the table every single year. The second step is maintaining broad market exposure through low-cost index funds rather than attempting to identify specific winning sectors or individual companies. The wealth transfer will benefit multiple asset classes simultaneously and in ways that are difficult to predict precisely. Broad exposure ensures participation in aggregate growth regardless of which specific areas outperform. The third step is developing skills that position you to serve capital in motion. Whether that means building expertise in financial planning, real estate, tax advisory, estate administration, or wealth management, aligning your professional capabilities with industries that grow during wealth transfers creates career and income advantages that compound alongside your investment returns. The fourth step is maintaining a cash reserve that allows for opportunistic deployment during periods of dislocation. The transfer will not move in a straight line. There will be moments when assets are temporarily mispriced due to forced selling or sudden shifts in market sentiment. Having capital available during those windows historically produces enhanced long-term returns. The fifth step is extending your thinking horizon. The transfer spans 25 years. The correct unit of measurement for decisions made today is decades, not months. Decisions that feel uncomfortable in the short term because markets are volatile or uncertain are often the exact decisions that look obviously correct from a decade's distance. The sixth and most overlooked step is having honest financial conversations with the people closest to you. And understanding the financial landscape of your family, whether you are in a position to potentially receive an inheritance or to leave one, allows for planning that makes both outcomes more efficient and more beneficial for everyone involved. Carol does not think of herself as a financial genius. She will tell you that directly if you ask her. She was not working from a sophisticated model or a proprietary strategy. She was a nurse who had watched enough difficult moments in her professional life to understand that the periods that feel the most dangerous are not always the most dangerous. Sometimes they are the most valuable. She made one decision at one specific moment, stayed committed to it through years of doubt and noise and fear, and it changed the trajectory of everything that followed. What is unfolding right now is bigger than the moment Carol acted on. The numbers are larger, the timeline is longer. The number of people who stand to benefit is greater. History will record this period as one of the defining wealth creation events of the modern era. The question that matters, the only question that actually matters when you strip everything else away, is not whether this transfer is real. The research confirms that it is. It is not whether ordinary middle-class people will benefit. History confirms that they will. The only question is whether you will be among them. You now know what is happening. You know why it matters. You know what the people who benefit most will have done differently from those who look back with regret. What comes next is entirely up to you.